Have you ever wondered how to maintain steady dividend income when markets turn bearish? What if I told you there's a way to not only protect, but potentially boost your income during market downturns? The JPMorgan Nasdaq Equity Premium Income, ETF, or JEPQ, might just be the solution you're looking for. In this video, I'll show you how this innovative ETF uses option strategies to generate consistent income even when tech stocks are plummeting. Let's face it, dividend investing can be challenging in today's volatile market environment. Traditional approaches like buying and holding dividend stocks often leave investors exposed to significant downside risk during bear markets. When tech stocks crash, your income stream can dry up faster than a puddle in the desert. Harry, like many investors, faced this exact dilemma. He had built a portfolio of quality dividend ETFs that performed well when markets were rising. But during the 2022 tech sell-off, he watched his account value drop over 30%, while his income declined as companies cut their dividends. The situation left him wondering, is there a way to maintain dividend income without sacrificing long-term growth potential? This is where covered call ETFs like JPQ enter the picture, offering a potential solution to this common investment challenge. JEPQ, the JPMorgan Nasdaq Equity Premium Income ETF, represents a sophisticated approach to generating income from technology stocks. Unlike traditional dividend ETFs that rely solely on company payouts, JEPQ employs a covered call strategy to create additional income through option premiums. Launched in May 2022, JEPQ has quickly gathered assets of over $23.4 billion, showing strong investor interest. It currently offers an impressive dividend yield of approximately 10.99%, paying distributions monthly rather than quarterly like most dividend stocks. What makes JEPQ particularly interesting is how it blends growth potential with income generation. The fund holds Nasdaq 100 stocks, primarily technology companies, while using equity-linked notes, ELNs, to implement its covered call strategy. This structure allows it to generate high income while maintaining some exposure to potential market upside. To understand why JEPQ works as a bear market strategy, let's break down its approach. First, JEPQ creates a portfolio of Nasdaq 100 stocks, similar to what you'd find in the popular QQQ ETF. The top holdings include tech giants like Apple, 7.81%, Nvidia, 6.74%, Microsoft, 6.39%, and Amazon, 5.02%. These are high-quality growth companies that tend to perform well over the long term despite occasional market corrections. But here's where JEPQ differs from conventional index funds. Instead of just holding these stocks and hoping for price appreciation, JEPQ's managers sell covered call options against the portfolio. Specifically, they use equity-linked notes, ELNs, that incorporate covered calls written at approximately 1-month expirations. What does this mean in practice? Let's use Harry's situation as an example. If Harry invests $100,000 in JEPQ, he's essentially getting two sources of income: the modest dividends paid by the underlying Nasdaq stocks, the premium income generated from selling call options. When the market drops or trades sideways, those call options expire worthless, meaning JEPQ keeps all the premium income. This is then distributed to shareholders as monthly dividends. This strategy allows JEPQ to maintain high income payments even when stock prices decline. However, there's a trade-off. JEPQ typically sells call options that cap potential upside at around 3 to 5% monthly. This means if the Nasdaq surges higher, JEPQ will underperform a straight Nasdaq index fund like QQQ. But in exchange, JEPQ investors receive that consistent monthly income regardless of market conditions. The dividend growth potential of JEPQ is also worth noting. While its dividend yield of nearly 11% already places it among the highest-yielding ETFs available, the fund has demonstrated the ability to adjust its distributions based on market volatility. When market volatility increases, option premiums tend to rise, potentially leading to higher distributions for JEPQ shareholders. For comparison, let's look at how JEPQ's monthly income compares to other popular dividend options. SCHD, Schwab US Dividend Equity, ETF, 3.49% yield paid quarterly. VYM, Vanguard High Dividend Yield, ETF, 2.61% yield paid quarterly. DGRO, iShares Core Dividend Growth, ETF, 2.16% yield paid quarterly. JEPQ, 10.99% yield paid monthly. The monthly payment schedule is particularly valuable for investors who rely on their portfolios for living expenses, as it better aligns with typical monthly bill cycles. So how should investors incorporate JEPQ into their portfolios, especially as a bear market strategy? Here's a strategic framework. 1. Core and satellite approach. For most investors, JEPQ works best as a satellite position around a core of more traditional dividend investments. Here's how Harry might structure his portfolio. 50 to 60% in core dividend ETFs like SCHD, VYM, and DGRO for long-term growth and moderate income. 15 to 25% in JEPQ for enhanced income, especially during bear markets. 15 to 25% in other investments like bonds, REITs, or international stocks. This balanced approach provides multiple income streams while maintaining exposure to long-term growth. 2. Bear market income. Booster JEPQ can serve as a tactical allocation during anticipated market downturns. When economic indicators suggest a potential recession or tech sector correction, shifting a portion of your portfolio into JEPQ can help maintain income while reducing downside risk. For example, when Harry saw warning signs of a tech correction in late 2021, he could have reallocated 20% of his tech exposure to JEPQ. While this wouldn't have completely protected him from price declines, his income would have remained more stable through the downturn. 3. Reinvestment strategy. One powerful approach with JEPQ is to use its high monthly distributions strategically. During bear markets, reinvest a portion of the distributions into growth-oriented ETFs at discounted prices. During bull markets, take the distributions as income or reinvest in more defensive assets. This flexible approach allows you to buy low with your dividend income, potentially enhancing long-term returns. 4. Tax considerations. It's important to note that JEPQ's distributions are generally not qualified dividends. Because a significant portion comes from option premiums, the distributions are typically classified as ordinary income. This makes JEPQ most tax-efficient in retirement accounts like IRAs or 401ks. For taxable accounts, investors need to weigh the higher yield against the less favorable tax treatment when comparing to ETFs like SCHD that predominantly pay qualified dividends. Let's compare JEPQ with other income-focused ETFs to see where it shines and where it has limitations. JEPQ versus QYLD. Both are covered, call ETFs focused on the Nasdaq 100, but with key differences. QYLD sells call options at the money, capping virtually all upside potential. JEPQ uses a more selective approach, potentially retaining more upside. QYLD has a longer track record, since 2013, with a slightly higher yield of 12.68%. JEPQ benefits from active management by JPMorgan's team. JEPQ versus JPY. JEPI is JEPQ's sister fund focused on the S&P 500 rather than the Nasdaq 100. JEPI has broader sector diversification with more defensive characteristics. JEPQ offers more technology exposure and potentially higher growth. JEPI typically has slightly lower yield, 7.14% versus JEPQ's 9.91%. Both use similar ELN structures and active management approaches. JEPQ versus SCHD. These represent different approaches to generating investment income. SCHD focuses on dividend growth companies with strong fundamentals. JEPQ generates income primarily through option premiums. SCHD has significantly lower current yield, 3.49% versus 9.91%. SCHD offers better upside potential in strong bull markets. The expense ratio differences are also worth noting. JEPQ, 0.35%. QYLD, 0.60%. JEPI, 0.35%. SCHD, 0.06%. While JEPQ's expense ratio is higher than traditional dividend ETFs like SCHD, it's competitive among actively managed option income strategies and reflects the more complex investment approach. Let's examine what Harry could expect from a $100,000 investment in JEPQ compared to alternatives, with a focus on bear market scenarios. Scenario 1. Flat market 0% price appreciation. JEPQ $10,990 annual income $916 monthly. SCHD $3,740 annual income $312 monthly. QQQ, $700 annual income, $58 monthly. Scenario 2, bear market -20% price decline over 1 year. JEPQ, portfolio value drops to approximately $89,000, but still generates approximately $9,790 income. SCHD, portfolio value drops to approximately $84,000, generates approximately $3,135 income. QQQ, portfolio value drops to approximately $80,000, generates approximately $560 income. Scenario 3, long-term investment, 10-year projections. Let's assume a 10-year period with mixed markets. 3 bear years, -20% each, 4 flat years, and 3 bull years, plus 20% each, starting with $100,000 in JEPQ with all dividends reinvested. Year 1 bear, $89,000 portfolio, plus $10,990 reinvested equals $99,990. Year 2 flat, $99,990, plus $10,989. Reinvested equals $110,979. Year 3, bull $133,175, plus $13,317. Reinvested equals $146,492. Year 10, approximately $283,300. This compares to SCHD, $306,400 with reinvestment. QQQ, $277,500 with reinvestment. These projections illustrate that while JEPQ may slightly underperform SCHD over a full market cycle with dividend reinvestment, it provides much more consistent income during bear markets, making it valuable for those depending on portfolio income. For a retiree taking distributions rather than reinvesting, JEPQ's advantage becomes even more pronounced during market downturns. In summary, JEPQ offers a compelling strategy for protecting and even enhancing your dividend income during bear markets. Its covered call approach generates substantial monthly income while maintaining some exposure to the growth potential of Nasdaq 100 stocks. Is JEPQ perfect? No investment is. Its high yield comes with trade-offs, including potential underperformance during strong bull markets and less favorable tax treatment. But for investors seeking consistent income through all market conditions, JEPQ deserves serious consideration as part of a diversified portfolio. The best approach may be combining JEPQ with traditional dividend growth ETFs like SCHD or DGRO. This provides both current income and long-term dividend growth potential, giving you the best of both worlds. What's your take on covered call ETFs like JEPQ? Have you incorporated them into your income strategy? Let me know in the comments below. And if you found this breakdown valuable, please hit that like button and subscribe for more dividend investing insights. Next week, I'll be comparing JEPI versus JEPQ to help you decide which JPMorgan income ETF might be right for your portfolio.